Okay, so hi Akash, I can see that you're online. I have somebody else who has joined as well, Arundhati as well. So let's just give the others maybe about 3 to 5 minutes. Okay, so if they want, they can join. Right. So while I wait for the others, let me just give you a quick plan for this TRG. Okay, so you can see we have exactly 5 days in which we can do revision. Good evening, Arundhati. Okay. Yeah, okay. Right. So let me put the plan for these 5 days. Right. Okay. So my idea is that I want to make the most out of these 5 days that I have. Okay. So by making the most, what I mean is I want to cover as much as possible with regard to the syllabus. Okay. But obviously, I can't start from zero and finish off at 100%, just like how we do at a lecture, because obviously 5 days is not enough to do that. Okay. So my approach is I have about 100 MCQs. Okay. So I have about 100 MCQs from all areas of the syllabus. Okay. I'm typing it because in case somebody joins in, I don't want them to feel lost. Okay. So 100 MCQs from all areas of the syllabus. Okay. So some of you I can see are from classes that I have taken. Some of you may not have, attended a lecture that I have taken. That doesn't matter. The point is that all of these questions, they are from major areas of the syllabus. So what that means is we are aiming at covering at least, okay, I'm saying at least 90% of the syllabus. Okay. So before I do a question, especially the first 2 to 3 days, before I do a question, I will give you a very small, like a recap of that particular area. Okay. So for examples, if I look at this very first question, they're talking about overheads. Okay. So I will give you a small recap of that particular chapter, overheads. Okay, so likewise, the second one is about process costing. So I will give you a small recap of process costing. So that's how it will work. Okay, so ideally, by the time we're done with these 100 questions, we should be done with 90% of the syllabus. Now, you might have a question, what happened to the other 10%? The thing is this, right? Although we have a big syllabus, weekly 1 day, Arundhati. So we will have it on every Thursday. Okay, so once a week. Right. So I was saying, yeah, with regard to the other 10%, it's like this, right? Although we have the entire syllabus, you have to understand that there are some areas that are highly examinable. What that means is some areas are there where sometimes we feel like, okay, it's hard, we have to learn it and all that. But the probability of that actually reflecting in your paper as a question is very low. Okay, understand that. So you have to be really good at the areas where you will get most of the questions. No point learning these niche areas where, it's just there. Even if you get it, you will only get it for 2 marks. Okay, it's good to know 100%. I'm not saying no. But what I'm trying to put forward is we don't want to waste time with areas that are not very examinable. Now, having said that, that doesn't mean we will be skipping chapters or anything like that. It's just that there are certain areas of certain chapters which are not examinable, and you might not find a question with regard to that particular area. Okay, so that's my point about 90% of the syllabus. Okay, right. So the third thing is that I am making an assumption here because end of the day, this is a revision class, right? So revision class means you have at some point in the past done some lecture for MA, right? And anybody, you have done some lecture for MA, right? So we are going to, go about these questions with a simple assumption that you know the basics quite well. Okay. So for example, if I use the word overhead, I'm assuming that you know what overhead is. Okay, we can't be talking about, okay, what is an overhead? That will take time, right? So we assume that you have the bare basic knowledge. Upon that, I will build up whatever we are doing. Okay, so that is that. Right. So basically, that's the plan. Nothing complicated. We just have a bunch of MCQs. We will do it. If we have more time, we can, look at MTQs as well. The reason why I'm not looking at MTQs initially in the plan is because if you look at an MTQ, chances are that you will take a lot of time, but you won't cover a big area because one question has 5 sub-questions. And each sub-question will all be from that same area. So for example, if we are looking at variances, we might end up, taking about 20 minutes just for that one particular area. Okay. So that's the reason why I am not looking into that. All right. So since this is the first class, I think it's 6:10 now, so we can start. Let me start off by giving you an introduction of this paper in case it has been a while since you, listened to it, or it's been a while since you went for a lecture. Okay. Right, so let me go to an introduction slide before we start off with the questions. So I hope you guys can see the slide. This is very important, right? It's important to know where you stand with regard to this particular paper. Okay, that is important, right? So most of you should be knowing that ACCA has 3 different levels. Okay, we have the knowledge, the skills, and the professional level. So where does this MA paper stand? It stands in the knowledge level. Okay, so basically this paper, you will not have, most probably you won't have previous knowledge per se. Okay, now for example, this financial accounting paper, this business and technology paper, if you had done A-levels, to some extent, you will have some prior knowledge, but MA, there is a good chance that you won't, maybe you will have about 10-20% knowledge, but there is a good chance that you might not know what the paper is talking about. That's a good thing and that's a bad thing as well, because we start fresh. Now, if you do FA, what happens is some students will be properly, they know what's happening. There will be another set of students who will be completely lost. Okay, so that kind of mismatch will happen with something like FA as well as BT. But when it comes to MA, that mismatch will never happen because everybody doesn't know. Okay, so if everybody doesn't know, we don't have a choice. We have to start from scratch only. Okay, so that is where management accounting stands as a paper. Now, what I am more interested in is this part. Okay, the syllabus. Okay, right. So when it comes to MA, the syllabus is divided into 6 major areas. Okay, 6 major areas. The first one is actually a very small area where we try to collect good information. Okay, I'll explain to you why you have to collect good information. Okay. Then I'll just come back to this in a bit. If you look at the third area, it's called cost accounting techniques. What is that? Basically, if you're running a business, now understand this, right? Management accounting means we are talking about how to run a business. We are not concerned about the financial data. We are not concerned about the profits or the losses. We are concerned about how to run a business effectively, efficiently. Okay, so one of the first things that we have to do, and most of the time, let me put it this way also, 80% of the time we are considering a manufacturing environment. Now today, in today's day and age, having a manufacturing environment is actually very rare, right? We actually have trading, we have a lot of services that happen, but in terms of manufacturing, we don't really have that many companies that I know. But then again, if you are having a company, if you have factories, then how are we going to go about the accounting? That is what this paper is about. And why is it so important? Because whether you like it or not, guys, manufacturing only gives other people jobs. Manufacturing is the area that gives other people jobs. Now, if you are just doing trading, for example, you will have maybe millions of dollars of turnover, but you will only have maybe 10 staff. Okay, in terms of how you are contributing to the economy, only if you're a manufacturing business, you're really contributing. If you're a trading business, chances are that you aren't. Even if you're a service-based oriented industries, chances are that you aren't. Right? So that is the importance of manufacturing industry. So that is why we actually dedicate a particular line of papers for this area of business. So speaking of particular line of papers, I'm talking about management accounting. We follow that with performance management, and we follow that with advanced performance management. So all these three papers, they have that, same core, basically, how are we going to run this business? Okay. So one of the most important things that we have to do is first we have to cost our product. Okay. No point making a product and then figuring out, okay, how much should I sell this for? How much is the cost fine? Okay. Because end of the day, this is the situation, right? You will have a customer. Most of the time, you will have a customer who will come to you with a requirement. Okay, so for example, I may be your customer. I will come to you and say, for the month of September, I need about 1,000 tables. Can you please manufacture 1,000 tables and give it to me? You will be more than happy. Yes, 1,000 tables may be a big order. You will say, okay. But then my follow-up question is, okay, how much is it going to cost? I can't tell, the supplier, the one who is giving the tables, he can't say, wait, I will manufacture the tables and then decide on how much I spent, and then I will tell you the cost. Nobody will be happy doing business that way. Everybody wants a cost upfront. So if you have to have a cost upfront, you should know beforehand itself how much it will cost you to actually produce one table. That is cost accounting, figuring out how much it is costing you per unit. Okay, so that's what we do in the cost accounting techniques. Then we have another area, we call it budgeting. Budgeting is very simple. It's planning for the future. Okay, so especially when it comes to manufacturing, guys, it's not simple to plan. I'll just take an example of a service industry. Let's say, like, for example, we are PPIM. We conduct lectures. Now, to plan lectures for the next period, we just have to look at basically two things. One is we have to look at the availability of the lecturer. First thing. The second thing is, if it is a physical class, the availability of the class. Okay, otherwise there's nothing else, right? If it is online, then anybody can have it anywhere. So that's not a problem. So planning in a service-based industry like this, think about it. If I want to plan for next month, I can just sit in 2-3 hours and plan it. That's it. But the same situation, think about a manufacturing industry. If we have to plan, okay, how many tables we are going to produce in, say, the next month, which is June, there are a lot of factors that have to come into play. First, we have to consider the raw material. The wood. Do we have wood? If we don't have, we have to ask our supplier to send us the wood. How long will that take? First question. Next question, will there be people willing to work in the month of June? Is there any poor day coming up? Okay, is there a festival coming up? For example, if it was April, 2 weeks, nobody will come, right? It's the holidays. Okay, is there something to do with a power cut or something? Is that a problem? There was a period where we were having a lot of power cuts, so then we have to consider that as well. Okay, now we planned everything. Are we going to have a demand? Will people actually buy our goods? If not, where are we going to store it? Is our warehouse okay? Is there space, basically? So if you look at a manufacturing industry, since there are both people as well as a product involved, two things, there is a lot of planning that has to go into what we're going to do. Okay, so this planning for the next period, we have a posh name for it. We call it a budget. That's about it. Okay. Then we look at the other area, which is standard costing as well as variance analysis. This is where we compare our plan, our budget, to what actually happens. Okay, so we compare what our budget was. Let's say we budgeted to produce 10,000 tables at a cost of $5,000. But actually what happened? We produced 10,000 tables, fine, but the cost became $6,000. The question is, why did that increase of $1,000 happen? No point preparing a budget if you're not going to stick to that budget. It's just like you're doing it for the sake of doing it. There's no point doing that, right? If you prepare a budget, then what actually happens also should be in line with that budget. So if that, if there is no connection, if there is no, like a sync between the budget and the actuals, there is a problem, which you have to address. You have to make sure, okay, fine, what's gone is gone. No point worrying about what happened in the past. But at least in the future, whatever budget that you make, it has to be in line with the actuals as much as possible. That is what standard costing is. We're trying to figure out why was there a variance. Variance means a difference between the budget and the actuals. Then we look at performance measurement. This is actually kind of connected to your financial accounting, where we try to analyze the performance as the business as a whole. Okay, so for the entire year, probably you can see, okay, how did we do? How are our profits? Are we happy with the profits? Okay, now for example, there might be a new policy that you took. Okay, let's say, for example, you are a supermarket. All of a sudden, one year, you decided, I am going to stop, selling, whatever goods that somebody buys from me, usually you used to put it into like shopping bags. Suddenly you made a decision, no, I'm not going to give bags. Okay, I'm going to become eco-friendly. I'm not going to give bags. People have to bring their own bags if they're coming. Okay, now that policy, think about it, guys. That could affect your business in a way, right? Think about it. For example, actually, this used to be a problem, not in Sri Lanka, because here you can somehow, coax them to put it in a bag, right? But in countries like India, where the government itself banned bags, there used to be a time where if you don't have a big bag, then you can't buy a lot of groceries, right? So what did people end up doing? The volume that they buy, it kind of reduced. Okay, because chances are that they came in a bus or they came in a tuk, or they can't carry so much of things in their hand because they don't have a bag, they forgot it or something. So what happens? They used to just buy the bare minimum that they needed. So for example, if somebody went to buy soap, they will just buy soap and come. They won't buy anything more than that because they can't carry it, simple. Right? So now this supermarket who came up with this policy of 0 bags, that may have affected their profitability. Okay, so that kind of analysis you can do when it comes to performance measurement. How did we do as a business? Maybe there was a policy that we made like this and it actually reduced your profit. So maybe in the next period, you have to think about, selling something like, like an eco-friendly bag or something. Because if not, what is happening? People are buying as less as possible. Okay, so that is performance measurement. Then we'll come back to the first one, right? Whatever you have to do, that is the cost accounting, the budgeting, the standard costing, performance measurement, whatever you have to do with regard to the other 4, you need good information to do it. Now, for example, if you want to cost your product, you have to have good information with regard to how much it will cost to get raw material, how much it will cost for your labor, what is your overhead cost. All of those costs, you have to have accurate figures. If somebody is coming and giving you wrong figures and using that to calculate the cost per unit, obviously it's going to be wrong, right? So the first part of this syllabus, we try to focus on how to collect good information and the characteristics of good information. Okay, and the final area is where we don't stop at just, the present. We try to forecast future values as well. For example, we try to forecast our sales for the next 5 years, our cost for the next 5 years. Because if we can do this forecast, it will definitely help us with our planning. So how can we do forecasting? Now understand that accounting is techniques that we use to analyze something that happened in the past. Okay, think about it: income statement, balance sheet, statement of changes in equity, all your statements. It's just summarizing historic data, right? But if we want to analyze something for the future, if we want to get information about the future, accounting is not going to help us there. Okay, so what do we have to help? What will help us? Basically, statistical techniques. Now, statistics is ideally an area of mathematics, and that is where we can forecast future numbers. So we can't use accounting to do that. We have to use statistics to do that. So we don't go into detail with regard to statistics, honestly. We just touch it at, a little bit. We just touch it slightly, and then we just finish it off there. And most of the equations that you need with regard to statistical analysis is all given at your exam. Nothing is meant to be memorized for this particular paper. Okay. Right. So that's your syllabus. So if you know this, you will be able to figure out now which area will come under which chapter. Okay. Right. Any questions? Akithma, Arundhati, and Akash? If you have any questions, feel free to drop it in the chat, okay, anytime. Right. So finally, let's just look at this exam structure. Again, you might have done a previous exam in the knowledge level. If you have, then it's the same, exact same. If not, this is how it will look like. Okay. So you have basically two sections. One is section A, where you have 35 objective questions. Objective questions means they are short questions. Okay, so just a small paragraph and you will have A, B, C, or D. You have to choose the correct answer. So they're very small questions. Each question will carry 2 marks. Okay, so if you're done with section A, we have finished off with 70 marks of your paper. So 70% of your paper is done at section A itself. Okay, so now we only have a remaining 30 marks. So how do we get this remaining 30 marks? Basically, you have section B. Okay, so under section B, we have 3 big questions. We call it a MTQ or a multitask question. Each of them is worth 10 marks. Okay, so 70 plus 10, 10, 10 will give you 30 there. So 70 plus 30 will give you 100 marks. Now, examiner has told you these 3 big questions worth 10 marks. They will always be from these areas: budgeting, investment appraisal, standard costing, and performance measurement. Okay, so most of the time, or almost all of the time, you will have your MTQs only from these areas. So you won't have MTQs from the first area, like the nature and purpose of good information, for example. You won't have an MTQ based on statistical techniques. Okay, it will always be from these areas. 10 marks means obviously it won't be just one whole big question. It will be broken down into smaller parts. Okay, so actually when you do the MTQ, you won't feel much of a difference, right? More or less, it will look just like an MCQ. Okay. Right. So it's a computer-based exam, as always, 2 hours, and the pass mark is 50%. All right. So that's it about your introduction. Let's start with the question. So there were a few of you who joined after I mentioned the plan. So basically what I'm planning to do is this, right? So I have 100 MCQs for you guys from all areas of the syllabus. It will cover 90% of the syllabus in terms of theory. And before doing every question, I will give you a quick recap of what that area is about. Okay. Right, so let's begin. Okay, so if you look at 19.1, it says the following data relate to product D. Okay, so there's a particular product. They're saying the material cost per unit is $20. The labor cost per unit is $69.4. The production overhead cost per machine hour is $12.58. Machine hours per unit is 14. And general overhead absorption rate is 8% of the total production cost. Okay, so they are asking you, what is the total cost per unit of product D to the nearest $0.01? Okay, so there's nothing too much to think, right? Once you look at it, you can understand that this is definitely from the costing area of your syllabus. So they are giving you a breakdown of all the different costs that you will have to incur for this product D. And they are asking you what is the total cost per unit. So obviously you have the breakdown. It's simple. Just add up all the costs one by one. Okay, so let's start. Oh, by the way, I will share this document on the Telegram group. Okay. So mixed bank 1. Right. So let's go one by one. We have materials, that is $20. Then we have labor, that is 69.40. Okay. Right. So then they're saying, what's the total cost per unit of product D? So we don't have to stop here. We can add the others as well. So we have the production overhead cost per machine hour. Okay, so that means this 12.58 is the production overhead cost per machine hour. So if you want just the production overhead cost, you have to multiply this figure by the machine hours figure. Okay, because it's like this. Okay, let me show you this. Production overhead per machine hour. Okay. Now we don't want this figure, production overhead per machine hour, right? We only want the production overhead section. So if you want to remove the machine hours from this, then this is a division now. So if you multiply it by the machine hours, it will get cancelled off. So that is why we do the multiplication. Okay. Right. So production overheads. So that is going to be 12.58 multiplied by 14, which will give us 176.12. Okay. Right. Then we have the general overhead absorption rate. It's 8% of total production cost. So now, when you talk about production, we have materials, labor, and overheads. Okay. Now, if you take a total here, that will be called production cost. Okay, it will be called production cost. So let me do that. 20 plus 69.4 plus 176.12. That is 265.52. That's the production cost. Now they're saying that there is a general overhead absorption rate, which is 8% of the total production cost. Now, since we want the total cost, we have to add the general overheads as well. So that will be 8% of 265.52. Okay. So 8% into 265.52, that is 21.24. Let me just take it to 2 decimal places. Since it's money. Okay. So then you will have the total cost per unit. You just have to add everything together. Okay, so we already have 265.52. To that, you add this 21.24. So that is 286.76. Okay. Right. So that's it. 2 marks, 2 easy marks. Right. So you can take this down while I quickly share this document on Telegram. Okay. I hope all of you have joined that group. MA. Oops, I'm sorry. Give me a minute while I just share it, so you guys also will have access to it. So it's the mixed bag questions, okay? Okay, welcome. ACCA Study Hub access. Yes, I will. I will, Akash. Right, so take this down. Let me know once you're done. And since Akash is asking, I will show you the Study Hub as well. So actually, this is not a normal question also, although it looks normal. Because usually until this point, that's materials, labor, production overheads, we know. Okay. But after that, taking 8% of production cost, if you didn't know that these three added together is the production cost, you won't get your answer. Okay, so you have to be a little vigilant when it comes to this kind of a question, because here they are kind of testing just your general knowledge, right? Nothing else. Okay. Right. So like Akash had asked before, in addition to whatever resources that you're using, so you might be using the Kaplan study text, you might be using BPP, you might be if you had gone for a lecture where they gave you specific notes, then you might be using that, right? But now, in addition to all of that, ACCA has released their own set of study materials. So actually, it has been released in such a way that it can even be used as a substitute for a study text. Okay, so that is called the Study Hub. How do you access this? So for you to access the Study Hub, guys, you have to have an active ACCA registration. You have to be registered with ACCA. You should have your registration ID and the password. Okay. So the easiest way for you to access the Study Hub is first go on Google. Okay. And type MA ACCA Study Hub. Don't try to go through the ACCA website. Almost all the time, you will have a problem with it. Okay. Without an exam kit, I won't recommend Akithma. Okay. If you want, you can do an exam kit without the Study Hub. That might work. Because Study Hub is like a study text. It doesn't give you exam style questions. Okay, it's giving you questions like now when you're doing, for example, if you have seen Kaplan's study text, you would have seen TYU's test your understandings. So small questions just to help you understand the concept. But they are not exam style questions by any means. Okay, so if you don't have the revision kit, that's a problem. Okay, there has to be some place where you have a lot of questions to try just before your exam. So the revision kit is important. Study text may not be so important. Okay. Right. So the very first link that you see is the ACCA global site, and it will say ACCA Study Hub there. Okay. So come underneath there, and there will be two ways to log in. Log in via MyACCA, alternate login. This login via MyACCA, I don't know, it never works for me. Okay. It might work for you, but I always go for this alternate login. Okay. So then it says username, that's your ACCA ID as well as your password. So you can sign in. I think they have changed the location or something of the site. The other day also there was a small lag. All right. So you get this screen. It's a little slow. It says move to account user portal something. Click that link. Okay. Right. So once you come here, you should be able to choose your paper. Okay. So if you have never used the Study Hub ever, then you won't have anything in this in progress section. Everything will fall under this not yet started. Okay. So you can choose your paper here. For example, MA won't be here because I've already chosen it. So let's say you want to study FA. I'm just assuming. Then you just have to click this study option. Okay. So then it moves on to the dashboard. Okay. So for example, now here I have put in MA. So MA, if I want to study it now, so this is the FA thing. Now, if I want to study MA now, I just have to click on study. It's all free, right? If you have a ACCA account, it's free. Last year's one, not a big difference, Akitna. Only one area had been removed. Okay, one area had been removed. That is equivalent units when it comes to process costing. Okay, so that area you can skip. Don't waste time with that because that used to be an area where we spend a lot of time and it's a lot of effort that we have to put to make students understand that area. Now, thankfully, that area is not there anymore. Okay. So if you see anything to do with equivalent units and process costing, you can skip it. Otherwise, not much of a difference. Study Hub type questions for 10 marks. Unlikely, Arundhati. Okay, most of the time, when you're talking about the MTQs also, we are talking mostly about what we see in the revision kit. Because revision kit is the real exam. Okay, it's not somebody just, figuring out a question and asking you to try it out. It is something that actually came up at an exam at some particular point of time. So that is only going to repeat. With regard to the Study Hub, like I said, it's, you know, what they have in mind is for you to be able to understand MA without the need of a study text. They want you to understand this paper without having to actually have a Kaplan or a BPP study text. So ideally, this is going to, you know, kind of take over the place of study text, but the revision kits still, they don't have a proper platform. Whereas this now, if you look at here in this practice area, now let me just open something for you here. Now, can you see here, this Newcastle, Casilda, Flexed, Lancer, those are actually old questions. Okay. Now, this MTQ1, MTQ2, yes. Now, if you're talking about them, then yes, those are exam style questions, no problem. That is an example of how your exam will look like. But if you look at this area, behavioral aspects and all, they're just trying to help you understand. Okay, so I don't know how far you will see an MCQ just like that. But this, yes, now for example, I used to remember very well, a cab company is an old question. So if you start this practice, then yes, this is exactly what it will look like. Okay. Right, so basically, you can have a look at it. I know all of you must be very tech savvy. So quizzes also, again, it's to do with helping you understand that particular area. But the closest that you can get with regard to questions, and you know, the closest you can replicate a revision kit is this practice part. Okay. So yeah, you have every chapter properly, you know, segregated, so you won't have to mix anything together. Okay. So use it. Use the study hub. It will definitely help you. All right. Right. So the next question, just look at it. It's from an area called process costing. Okay. Now let me explain process costing to you really quickly. Okay. Now the concept is this. Okay. The concept is usually when it comes to manufacturing. Again, I'm talking about manufacturing industries, right? We input something called a raw material, right? So we input raw material. That's not. Okay. And that raw material, we do something to it in the form of processing. We process it in some way and we get output. Now this output is only your finished good. Okay, so we input raw material, we process it, and then we get our output, which is the finished good. That's not a problem. Okay, now the problem is this. Now let's say, for example, we are making cologne or perfume. Okay, so let's say we are manufacturing perfume. Right? So what is our input when it comes to perfume? We will have some kind of fragrance. Okay, so that you might get from a rose or a lavender or something, some flower. Ideally, you have the fragrance. To that, you will add alcohol. Okay, if you're having perfume, you will obviously add alcohol. Fragrance plus alcohol will only give you the perfume. Right? Now, the issue is fragrance, maybe if you input 2 ml of fragrance, that will remain as 2 ml. Okay, so let's say we put some roses into water. I'm just assuming you put rose into water and then whatever you keep it for about 6 to 8 hours. And then whatever water you have, you take that. That's the fragrance. Now that it might, if you take out 2 ml, it might be 2 ml. That's fine. But alcohol, if you put in 2 ml, let's assume that about 1 ml, it evaporates. You know what's evaporation, right? If you take perfume, you open it and keep, after a while, there won't be liquid in the bottle. Okay, because evaporation means it's becoming gas, basically, right? So now the issue is, although we have put in 2 ml of fragrance and 2 ml of alcohol, we don't get 4 ml of output. Why? Because 1 ml we have lost due to evaporation. So how much of output will we get? We will only get 3 ml. Okay. Now this 1 ml, we give it a name. We call that a normal loss. And why do we call it normal? Because we expect it. Anybody expects this, no? If you keep alcohol out, anybody knows that some amount will evaporate. And from our past experience, we might know that for every 2 ml that you keep, half of it will evaporate. So that is our past experience. So 1 ml, we call that a normal loss. Now losing 1 ml is not a problem because we expect it, it's fine. But when does the problem arise? It arises if you put in 2 ml of fragrance. Okay, as usual, let's say one day you put in 2 ml of fragrance, 2 ml of alcohol. But what happens, instead of 1 ml, 1.5 ml evaporates on that particular day. So what happens? Ultimately, you only have 3.5 ml of output. Okay, and we have 1.5 ml of loss. Now, this is a problem because we did not predict this. We did not expect this. When it comes to accounting or management accounting, we are not concerned about a loss. We are concerned about the fact that we can't predict a loss. Okay, because anyway, there will be a loss. The problem is if you can't predict it, then all your calculations will be wrong from that point onwards. So then in this case, what do? We give a special name. 1 ml, we call it a normal loss because that's what we expected. But the 0.5 ml, we call it an abnormal loss. Call it an abnormal loss. Because we did not expect it, it happened. So that is one situation. There can be a third situation, right? Same fragrance. It's a spelling mistake, just realized. Okay. Anyway, it's fine. Fragrance, right? Right. So we put in 2 ml of fragrance, 2 ml of alcohol. But what evaporates is, let's say, 0.5 ml. Okay. And how much output do we have now? We have, one second, did I make a mistake here? 4, 3. Sorry, if I lose 1.5, the output would be 2.5. Okay. Right. So 2 ml and 2 ml, I have lost 0.5 ml as evaporation. So as output, how much will I have? I will have 3.5 ml. Okay. And now how much have I actually lost? 0.5 ml. Okay. Now this 0.5 ml, it's still within my band for normal loss, right? Because normal loss, I can lose up to 1 ml. So this is still called a normal loss. Okay, but it has not fulfilled the full quota of the normal loss. There is still a 0.5 ml extra. So I expected to lose 1 ml, but I only lost 0.5. So the remaining 0.5 that I didn't lose, I have a special name for that. I call it an abnormal gain. Okay, so this is basically what you have to learn with regard to process costing. We used to have quite a lot more than this, right? We used to talk about equivalent units and stuff, but all of them have been removed from the syllabus, so you don't have to worry about it anymore. Now, the only area that you have to worry about with regard to process costing is this area. Okay, right. So I'll give you maybe about 3 minutes. See if you can figure out what the answer is. I have given you the theory. I have told you what we're talking about. Using this theory, see if you can figure out an answer. And drop your answers in the chat. D. So you're saying it's an abnormal gain and an abnormal gain. Both process 1 and 2. We'll see. Just check, double check once more. Abnormal loss and abnormal loss. Okay. So we have both extremes. One is saying abnormal gain and gain. We have another example, another answer saying abnormal loss and abnormal loss. What about the others? Right. So whenever you have this abnormal loss story, it's always good to have a structure. Okay. So let me just put up, a proper like a format, right? So we have process 1 and there was process 2. And input from the question was in kilograms. Process 1 was 47,000 and process 2 was 42,000. That part is fine. Then they're saying normal loss as a percentage of input. Okay, so normal loss. They're saying for process 1, the normal loss is 8% of your input. Okay, so 8% of your input means we're talking about 8 into the input, which is 47,000. Okay, so 8 into 47,000. 47,000 means we're talking about 3,760. So if you put in 47,000 kilograms, if there is a TRG today, okay. Right. So if you put in 47,000 kilograms, you can expect a normal loss of 3,760 kilograms. Okay, so that's the situation. Then you have process 2, which is 5% of input. But again, this is process 2's input. So that is 42,000. Okay. So 5% into 42,000. That will be 2,100. So we are expecting a normal loss of 3,760 for process 1 and 2,100 for process 2. So let's see what our expected output is. Okay, so it is 47,000 minus 3,760, which is 43,240. Okay, 43,240. And over here, 42,000 minus 2,100, which is 39,900. So what this means is if everything goes according to plan, meaning we put in 47,000 and we lost only 8% normal loss, then we should have an output of 43,240 and 39,900. But let's see if that is actually what happened. Okay, so we have the actual output. They've given it to us. They're saying for process 1, it was 42,000 and process 2, it was 38,950. Now see, I expected to have 43,240, but I only have 42,000. I have less. That means I have lost more than what I have expected. How much more have I lost? Take the difference between the two numbers. So I have lost 1,240 kilos more than what I calculated, what I predicted. So this 1,240 is an abnormal loss because I have lost more than expected. Here, if you look at it, I expected to have an output of 39,900. I have an output of 38,915. That means my output is less than what I expected. If your output is less, that means you have lost more than what you have expected. So again, this is also an abnormal loss. You can get the difference by just subtracting the numbers. An abnormal loss of 985. Okay, so process 1 as well as process 2, both are abnormal losses. They are not asking you for the figures. They just want to know if it is an abnormal loss. So again, in this case, both are losses. So answer will be A. Okay. So those of you who got it, so that is Arundhati, I think you got it. That's good. Akitma, just see where you went wrong. Okay, and if make the changes based on what I have over here. Okay, good, Akitma. Yes, it's on YouTube, Arundhati. Okay, so all of this will be shared on the PPIM YouTube page. I'm not sure if it will be there on the LMS, but definitely it's there on YouTube. Okay, but probably it will be there on the LMS as well. You can just drop a message on that Telegram group that we have for the TRG and check. I know definitely it's there on YouTube. That's not difficult to find. But in case you want the recordings on the LMS, it's available. Just drop a message on that group. LMS, Arundhati, are you an old student of PPIM? Or are you just joining just for the TRGs? Anything is fine. New, okay. So if you're new, then you won't have access to the LMS. LMS is basically a platform that we have. So it's like a learning management system. That's what it stands for. So it's like we have all our recordings and our lectures uploaded on that system. Okay, so every now since this is a TRG, it doesn't make sense. But if you are talking about a real lecture, okay, if you're there for tax, right? So you know what the LMS is, right? So if you have come for a class, for example, chapter 1 and 2, you want to see the recording for that particular chapter, then you need to log into the LMS using your PPIM credentials, and you will be able to have access to those recordings. That's about it. It's just a system like where you can go and find the recordings. But for the TRGs, it's available on YouTube as well. Okay. If you want, I think I'll find the YouTube channel name. Give me a second. PPIM. Yeah, it just goes as PPIM hyphen and ACCA. You'll find the logo. Under that, it will be there. Yeah, that was the previous TRG. Not two, there will be more. Okay, there should be about for FM as well as MA. So I think there should be about 5, 6, 7, 8, about 9 videos, but that was from the previous TRG. This particular one will also be uploaded today or maybe tomorrow. So you have to go on the YouTube channel basically, right? So if you click on PPIM and you go to videos, okay, now for now they have uploaded the AA revision game plan. Okay, so that was 59 minutes ago. Yeah, so if you go on the videos, it will come in order of time. So it'll be easier for you. Okay, so just go on the videos in the YouTube channel. Right now, it's not there. It will be there, hopefully, maybe today night or tomorrow. Okay. Right. So then we say, let's go to the 19.3 question, right? It says the following information is available for F company in the latest period. Okay. So they're talking about the original budget, a flexed budget, and actual results. So let me talk about this flexed budget once. Okay. Now, if you look at this original budget, right, we have a sales and production of 11,200. Then we have sales, that's 11,200 units we're expecting to produce and sell. Then sales revenue 224,000, direct materials 56, 66, 27, and a profit of 74.6. So this is original budget means the situation is like this. Okay. So let's say in the month of, now it's May, no, let's say in April. In April, we made a budget for the following month, May. In that budget, we said we have to produce 11,200 units. The sales revenue should be 224. Material, labor, overhead cost should be this. And end of May, we should have a profit of $74.6. This is the original budget, meaning it has been prepared in advance before the actuals happened. Okay, before the actuals happened. Now, let's say the month of May finished. Month of May finished. And we have actual results. So what are the actuals saying? It's saying we produced and sold 9,500 units. Sales revenue was 209. Direct material was 57. Direct labor was 56. Overheads were 28. And the profit was 67.9. Okay. Now I told you at the beginning, when I was just giving you an introduction, I told you, if you have a budget, you have to compare it with the actual. Okay, you have to compare it with the actual. So now, let's say I have this original budget, 74.6 should be my profit. Right? Now I go and call the general manager and I ask him, see, I gave you a budget. I told you to get a profit of 74.6. You have only got 67.9. What's wrong? I have to, probably give you a suspension. You're not doing so well. Okay. Now that may not be a very good comparison. Reason is, when we did the original budget, we said 74.6 is the profit, but that is if you sell 11,200 units. Now, actually what has happened, we have only sold 9,500 units. Obviously, the profit will be lower. If you sell less units, profit will be lower, right? Obviously. So, why did you make 9,500? Maybe that was for some other reason. Maybe there was a raw material shortage or a labor shortage, something that we couldn't really control ourselves. Okay. So it is not fair. My point is, it's not fair to compare these actual results with this original budget. Look at another figure. Let's say sales revenue. You're supposed to get 224,000. You have only got 209,000. Immediately you can't say, oh, okay, you did bad. Why did you get low? Because you sold less number of units, right? So obviously, it's not going to make sense to make a comparison with this original budget and these actual results because the sales and production units is different. Okay, so what do? We prepare another budget and we give it another name. We call it the flexed budget. Flexed budget simply means, now this was May, no? The original was actually prepared in April. Now let's say in April, when we were preparing the original budget, had we prepared it for 9,500 units, the actual number that we made, had we prepared it for 9,500, how will this budget look like? How will the sales revenue look like? What will be the direct material cost? What will be the direct labor cost? Okay, so basically we prepare that budget and we call it the flexed budget. So what will the original budget look like? Suppose we had prepared it for the actual number of units in the question. Okay, so once you prepare the flexed budget, it makes sense to compare it with the actuals. Why? Because the sales and production volume is same. Right? So now it's easy. You can compare. Sales revenue is supposed to be 190,000. You have got 209,000. You've got more sales revenue. That's actually a good thing. Right? Direct material cost should have been 47.5, whereas you have spent 57. You have spent more. That's a bad thing. Okay. If you look at labor, it should be 57.5. You have spent 56. You have spent less. That's good. Okay. And if you look at the profits, it's supposed to be 61, whereas overall you have made a profit of 67.9. Actually, you have done well in that period. Okay. So that is the reason behind the preparation of a flexed budget. When the actual number of units is different to the original budget, it doesn't make sense to compare the two. So we make another budget called the flexed budget. Okay. Right. So I've explained the budget to you. The question is saying, which of the following statements is correct? A is saying budgeted production volumes were achieved during the period. B is saying direct labor is a variable cost. C is saying the actual selling price per unit exceeded the standard selling price per unit. And direct material cost savings were achieved against the budget cost allowance. What do you think is the answer? What do you think is correct? Second, somebody wants the link to the TRG, I'll just send it to them and come. Right. Let's see if we have answer. So we have C, okay. Tell me, budgeted production volumes were achieved in the period. Is that true? We budgeted to produce 11,200. We actually produced 9,500. That means we have not achieved our budget. Okay. Direct labor is a variable cost. They're saying that. Actually, there's a way to find out whether it's variable. But I don't want to waste time doing that because I'll just read C and D as well. I'm just showing you exam technique. Okay. Now, if I try to figure out whether this is variable or not, it will take some time. I will show you how to do that. But at your exam, just read the other two and see if there is obvious answer available as well. C is saying the actual selling price per unit exceeded the standard selling price per unit. What they're saying is, let's say according to my budget, I expected to sell at $120 per unit. Actually, I have sold at maybe 125. So to figure this out, you have to look at the sales revenue. Okay. So if you look at sales revenue, for 9,500 units, I should have earned a revenue of 190,000. Whereas I have actually earned a revenue of 209,000, meaning I have earned more. Now, if you earn more, that could be due to two reasons. One is you sold more. But in this case, this is also 9,500 units. This is also 9,500 units. So the selling more part is not true. But the other reason when you can increase your sales revenue is if you sell at a higher selling price than the budget, which is what could have happened in this case. So C is saying actual selling price exceeded standard selling price. That is actually true because that is the only situation that can explain this increased sales revenue. Okay, so C is the answer. Correct, Arundhati. Then it says direct material cost savings were achieved against budget cost allowance. So if you look at budget, direct material, I am supposed to spend 47.5. Actually, I have spent 57. That is not cost savings. No, I have actually spent more than what I'm supposed to. So this is definitely wrong. Okay, so the answer there will be C. Now, since B is also there, let me just show you how to figure out if a cost is variable or not. Okay, so how you do that is, if you look at direct labor, it might be useful in another question. Okay, so if you look at direct labor, I'm supposed to spend 66,000 for 11,200 units. Okay, so 66,000 for 11,200 units. Right? Now that means per unit, the labor cost should be 66,000 divided by 11,200, which is 5.89. Okay, so if you want, just make this to 2 decimal places. Okay, so that is for, this is my original. Okay, now if you look at the actuals, okay, what happens? I am spending 56,100. Since everything is in thousands, I'm spending 56,100 for 9,500 units. That means per unit it's 56,100 divided by 9,500, which is 5.91. Okay. Now, if this was a variable cost, that means the cost per unit, it has to be same regardless of the number of units that you're producing. Right? Now, whether you make 11,200 or 9,500, the cost per unit would be the same if it's a variable cost. I'll explain variable cost in another question. But in this case, you can see the cost per unit, it's changing depending on the number of units. That itself is a sign that this is not a 100% variable cost. Okay, this is actually a semi-variable cost. That's why the cost per unit is actually changing from one number of units to another number of units. That's how you figure out if a cost is variable or not. Now, suppose this also gave you an answer 5.89, then for sure you can say that it is 100% variable. Okay. So I will explain this variable cost and all that in another question where we're talking about that. But since this B part is just asking you, whether this is variable or not, I'm just showing you the calculation to figure it out. Okay, so this is not a variable. So the answer there will be C. Right. So 19.4. Okay, it's saying variable costs are conventionally deemed to be what? Okay, so now that I said I will explain it, I will explain this part now. Okay. Right. So when it comes to costs, there are three types of costs that you can have. Okay. One is a fixed cost. One is a fixed cost. One is a variable cost. Okay. Then you have something called a semi-variable cost. Okay. So you have the fixed cost, the variable cost, as well as a semi-variable cost. And there is actually a fourth one also called a stepped fixed cost. Okay. Right. So what is a fixed cost? Okay. Now a fixed cost, the best example I can give you is say rent. Okay. So let's say we are running a factory. Okay. We are running a factory and the premises is on rent. That means we have to pay our landlord a particular amount for rent every month. Okay. So if you have to pay rent every month, let's say it's $5,000 per month, whether you run the factory or whether you close the factory, that $5,000, it has to be paid now. Okay. So whether you make 10,000 units of your product or whether you make 0 units of our product, the landlord doesn't care. Right? You will have to pay that $5,000 per month without fail. Yeah, you have to pay that $5,000 per month without fail. So that is an example of a fixed cost. Exactly. Rent is a fixed cost because regardless of the number of units that you produce, whether you produce units or not, even the landlord doesn't care. You just have to pay him the rent every month. Okay. So that's a fixed cost. Variable cost means it will increase as the number of units you produce increases. So the best example I can give you is that of raw material. Okay. So let's say we are making tables and each table takes 1 kilogram of wood. Okay, I'm just saying each table takes 1 kilogram of wood and the cost of 1 kilogram of wood is say $20. $20 per kilogram. Okay, so if you make one table, then the raw material cost will be 20. If you make 2 tables, then it will become 2 kilograms of wood. 2 into 20 will become 40. Right? So as the number of tables that you produce, as it keeps on increasing, what happens? The amount that you will have to pay for raw material, that also keeps on increasing. That's an example of a raw material. Sorry, that's an example of a variable cost. So most of the time, raw material is the best example for variable cost. Okay. Then we have something called a semi-variable cost. Semi-variable means it has certain elements of variable cost also. It has certain elements of fixed cost also. Okay. So for example, let's take something like an electricity bill. Electricity bill, right? Now, if you notice, I don't know if you guys pay your electricity bills. If you have seen an electricity bill, there will be two components. Okay. One is, we call it the fixed charge. That means whether you use electricity or not, even if you close your factory and go home for an entire month, this fixed charge you will have to pay. Okay, so that will be a small amount. It will be maybe a $20 or something. Okay. In addition to that, you will have the variable cost element. So that is depending on the number of units of electricity that you used, they will give you a charge. So for example, let's say 1 unit, they charge you say $2. Then if you used 100 units, you will have to pay them $200. Okay. So if you use 200 units, you have to pay 400. If you use 300, you have to pay more than that. So you can see that is an example of a variable cost. Fixed element is there. Variable element is also there. Okay. So that's a semi-variable cost. A stepped fixed cost is basically, again, you can take an example as rent. But let's say we have a factory where we have a capacity to produce 1,000 units. And for that factory, we pay $5,000 as rent. Now, let's say we grew as a business. And what happened? We ended up needing to produce about 2,000 units per month. That's the demand. Now, our first factory is not enough anymore. It's not enough, right? Because we only have capacity for 1,000 units in that factory. So then what do? We might rent factory number 2. And for that factory, maybe again you have 1,000 units capacity and the rent is another 5,000. So you can see from 0 units to 1,000 units, the rent will only be 5,000 because we only need one factory. But the moment you have to produce more than 1,000 units, then the rent will increase. At that point, it will actually become 10,000. It will become 5,000 more. Okay, so these are the different types of costs that you have to be aware about. You have to know about. Okay. So let's look at 19.4 now. It's saying variable costs are conventionally deemed to be constant per unit of output. What do you think? Is it constant per unit of output when it comes to variable cost? Yes. Okay, good. Yeah, because see, now when you take a fixed cost, guys, the total fixed cost, it will be constant, 5,000 per month. But let's say our production, okay, so let's say our production for a particular month is 1,000 units. Then this 5,000, it will be divided amongst these 1,000 units now. So the cost per unit, that will become 5,000 divided by the 1,000 units. It will become $5 per unit. Right? So as the production keeps on increasing, the cost per unit when it comes to a fixed cost, it will also keep on reducing because this 5,000 per month, it's spread out over more and more products. But if you take variable cost on the other hand, regardless of you're making 1 unit or 1 million units, the cost for 1 kilogram of wood will always be 20 kilos. So the cost per unit, it can never change. Cost per unit is going to be $20 per kilo. Okay. So the variable cost per unit, it is always constant. Whereas the fixed cost per unit, it will change depending on the production level. But when you're talking about the total fixed cost is always fixed. Whereas the total variable cost, that will change depending on the number of units. cost per unit for semi-variable and stepped fixed. Difference between cost per unit. Yeah, it's like this, right? If it is stepped fixed, Arundhati, in the question, they will mention that more than 1,000 units, they will tell you a story. We will need to hire another premises or something where they will give you an indication that it is stepped fixed. Okay, so you will be able to figure it out. But when it comes to semi-variable, if you want to get the cost per unit, then you have to use a method called the high-low method, which I will talk about when we come to that area. Okay, so if the step fix honestly is very rare, they don't give that in a situation. Semi-variable is very common. So if they want you to do step fixed, it will be, there will be some indication to show you that it is step fixed. Semi-variable, there won't be indication. Okay, you have to figure that out, you know how? Using this method. When you do the division, if it is not constant like this, then immediately you should know that this is a semi-variable cost. That's why it is not being equal. Because if it was equal, then definitely it's a variable cost. If it was fixed, that means it will be now 66,000 will remain 66,000 even in the actuals. But here, since that's not happening, this is an indication that it's a semi-variable cost. Okay, so here the answer is semi-variable means there is an element of a fixed charge as well as variable cost. So even if you don't make any units, okay, even if you don't make any units, 0 units, still you have to pay that fixed charge. That's what I gave you the example of electricity, right? So what happens even if you close your factory and go, meaning you have not even produced 1 unit in that month, still this fixed charge of $20 you have to pay. It's like a fixed cost, like rent, you have to pay it. Whereas if you use electricity, now if you use electricity, obviously you are making products, right? So the more products you use, the more units of electricity you will consume. So the more products you use, the more units you will use, the more the variable part of your electricity bill will keep on increasing. So it has an element of fixed as well as an element of variability. That's why it's called semi-variable. It has a mixture of both. Okay. Right. So 19.4, the answer will be A, be constant per unit of output. Right. So if you want, you can take this down if in case you have problems with fixed cost, variable cost, semi-variable, and step fixed. That's what I told you, Arundhati. If it is a stepped fixed cost, they have to mention that it was stepped fixed, or they have to mention that something about a characteristics of stepped fixed, they will mention. Either they will say you have to rent another building or something to show you that it is stepped fixed. Whereas if it is semi-variable, they won't mention anything like that. When you do the division, you will understand, okay, it is not the same, so definitely not variable. It has to be semi-variable. So like I said, stepped fixed, they have to tell you. Okay. Right. Take this down and you can try out 19.5 as well as 19.6. Both are simple areas. No problem. Okay, guys, if you all have doubts, ask, okay? It will make it a more interactive session and all of us will benefit from it. Okay, so good job there. Try out these 3. I'll give you about 5 minutes. See if you can get your answers. So 19.4 will be A. 19.5 and 19.6, see if you can get an answer. So we have answers, 19.5. Which of the following criticisms of standard costing apply in all circumstances? So this is a completely different area from what we were talking about. They're saying which of the following criticisms. Okay, so I think you know what's a criticism. It's like a disadvantage of standard costing applies in all circumstances, right? So let's read them one by one. Standard costing can only be used where all operations are repetitive and the output is homogeneous. What that means is, standard costing means what? We are trying to tell you this is the cost per unit. This is what it should be. Okay, the cost per unit should be $22. We're saying that. Okay. Now they are saying only if the operations are repetitive and output is homogeneous, we can have standard costing. That is not true, guys, because let's say you have a one-off project. Okay, you have to build a house. You have to build a house for a particular client. Now, this is not repetitive. It's not homogeneous. Homogeneous means all your products are looking the same. That's also not true. If you're a builder, you won't build the same type of house. Everybody know. Okay. But even in that scenario, you can have standard costs. So you can say by the time you finish building this 3-story house, it should have costed you $15,000. That should have been the cost. Then you can compare that with the actual cost you incurred and see if there were variances. So standard costing doesn't mean you have to have repetitive operations and the output should all look the same. That is not true. Okay, so that is not true. One is wrong. Standard costing cannot be used in environments which are prone to change. They assume stable conditions. Not true. If something is changing, change the standard. Right? Now, for example, we use standard costing in manufacturing environments. Now, in manufacturing, one thing that keeps on changing is the raw material price. Okay, if you buy something for $2 today, tomorrow it will become $2.5. Now, that doesn't mean we don't have budgets. No, we have. We just make the changes. Right? So, the second one is also wrong. We can't have stable conditions, right? That is unrealistic. Standard costing systems assume that performance to standard is acceptable. They do not encourage continuous improvement. That's actually a nice point. What they're trying to say is, let's say I had a standard cost per unit of say $20. $20 per unit. Okay. Now actual cost per unit, let's say we could do it at $18 per unit. Okay. I told my worker, do this for $20. He actually does it for less for me. Will I be happy or not? I will obviously be happy. I told him to do at 20, same quality. He has done at 18. So in this situation, I won't call him and scold him. I will actually call him and appreciate him. Okay. So if you can stick to the standard, great. But if you can do better than the standard, even better, that makes me even more happy. So what they're saying here is, if you give somebody a standard of 20, he should only do it at 20. That is wrong. If he does that less, I'll still be happy because he has improved, continuous improvement. So this point is also wrong. Okay, correct. So none of them are correct. All three are wrong. Answer is D. Okay. Which of the following relates to capital expenditure? Okay, this you should be knowing. That's why I asked you to do it, but I'll just mention it, right? So there are two types of expenses, right? One is a capital expense. Okay. The other one, we used to call it a revenue expense, but we don't call it that anymore. Now we just call it a normal expense. Okay. So let's just call it just an expense. Okay. Capital expense versus this normal expense. What's the difference, right? There's actually one main difference. That is, basically where you put this expense in your accounts. Okay. Now, if you have a capital expense, ideally, this will be a large value. Monetarily, it will be a large value. Okay. So, if you put this directly as an expense in your income statement, chances are that you will end up with huge losses that year, because capital expense is actually large in terms of monetary value. Okay, so what do we do with capital expenses? Instead of putting it in the income statement, we take it to the balance sheet or the statement of financial position. We put it there as a non-current asset. You must be familiar with this non-current asset. And every year, what do? We release a portion of this non-current asset expenditure to the income statement in the form of depreciation. Okay, that's how we deal with the capital expense, because the value is large. And actually another reason is also there. The reason is large value plus we expect to use that asset for a long period of time, not just 1 year. Okay, the useful life of that asset will usually be more than 1 year as well. That's why we call it non-current asset. So for those reasons, what do? We go and put it in the balance sheet as a non-current asset, and we release a portion of that non-current asset expense to the income statement in the form of depreciation. Okay, so we have certain examples that fall under capital expense. So what are they? One is the purchase of a non-current asset. Purchase direct. Okay, if you spend 10,000 to buy the machine or buy the car, buy the building, all of that definitely is a capital expense. The second is the cost of enhancing a non-current asset such that it improves its earning capacity. Let me give you an example. Okay, so let's say there was a machine Alpha, name. Okay, the name of the machine is machine Alpha. Let's say it could produce, let's say this machine was making biscuits for us. Let's say we are Manchi. Okay, so we were making biscuits. It could produce 10,000 packets per hour. It could produce 10,000 packets per hour. Now, let's say demand increased for our product, and it will be nice if we can produce 20,000 packets per hour. Okay, then obviously we'll be able to up our production capacity. So now what do? We call a technician. He will look at our machine and he will say, oh my God, this is 20 years old. Old motor. That's why it's running a little slowly. He will say, you spend about $5,000 and buy a new motor. Spend about 5,000 and you buy a new motor. Then what will happen? You will be able to produce 20,000 packets per hour, like what you want. Okay. Now, my point is this 5,000 that you have to pay to buy this new motor, that will also fall under capital expense. Reason is, it is enhancing the non-current asset, meaning it's making it better to the point where we improve its earning capacity. Earlier, we could only earn, or we could only make 10,000 packets. We can only earn how much ever we can with 10,000. But now we can earn more because the capacity has increased. Okay, so this 5,000 also will be considered capital. So any other expense other than this, it's called a normal expense. We will put it in the income statement just as an expense, and then it will reduce your profit for that year. Okay. Right. So which of the following relates to capital expense? A, cost of acquiring or enhancing non-current assets. That is correct. Okay, that is correct. What else do we have? Let's just read. Expenditure on the manufacture of goods or the provision of services. No, that's not capital, because that is actually a day-to-day expense. Okay, so we will put that in the income statement. Recorded as an asset in the statement of profit or loss. Statement of profit or loss is income statement. First of all, we can't record assets in your income statement. So that is definitely wrong. Recorded as a liability in the statement of financial position. We record it in the statement of financial position, but not as a liability, as a non-current asset. So D is also wrong. Answer is A. Right. 19.7. We're talking about overheads. Okay. I'll give you a minute, or not minute, obviously it's not enough. I'll give you about 5 minutes. If you know about overheads, have a go at it. If not, I will talk about overheads from scratch. Okay. I just want you to give it a go, because sometimes if you can get it, that will give you a lot of motivation. Okay. Drop your answers in the chat, okay, if you have. OAR is 16.02. Let me check. Good, correct. Okay. I guess I can say most of you know what OAR is, so that's a good sign. What about the others? So the two answers that we got are correct, so that's good. Okay. So while you're figuring it out, let me just give you a quick recap of what an overhead is. Okay. Now, an overhead is a specific type of cost. So if you take any product, let's say we have a product, okay, product A, okay. Now, for this product, you can have standard costing. I didn't go through it, Shakil. You mean like after this? Because I didn't go through it so far. You mean variance analysis, right? Yeah, I will go through it, but not today. Okay, variance we'll do towards the end. Okay, right. So we have a product A. We will have different costs, right? We will have different costs. So one such cost is your direct material, your direct labor. Okay. Now, this direct material and direct labor, guys, it's very easy for you to attribute a cost to that particular product. Okay, because let's say, for example, direct material, we are using wood. Let's say each kilo of wood is say $20 per kilogram. Now, we will know for product A exactly how many kilograms were used. If it's a table, let's say we use 2 kilograms of wood, it will be very easy for us to say, okay, direct material cost is 20 into 2, 40. Simple. Okay. Same for direct labor as well. Let's say the cost is $5 per hour. Okay, $5 per hour. We will know exactly how long it takes to make one desk or one table. Okay, we will know that. As if you want to run a good factory, you have to definitely know that. So what will happen? It's easy. If we know that per table it takes us 1 hour, then the direct labor cost will just be $5. Simple. Now the problem arises with a specific type of cost called the overhead. Now what's an overhead? It's basically some cost that we can't directly attribute to that particular product. So examples are, let's say, rent or the electricity or maybe the water bill or maybe like a telephone line. Okay. Now these costs, the issue is this, right? Now let's say the rent is say $10,000. Electricity, let's just give random values, 2,500, water bill 1,500, and telephone bill is 500. Okay. Now the issue that I have is, I don't know how much of rent one table takes. I don't know how much of electricity one table takes, because unlike this kilograms and labor where I know the exact figure, I can't really say every table takes 2 units of electricity, or every table takes this much of rent, every table takes this many milliliters of water. It's very difficult for me to tell that, right? Because now, for example, if you take telephone bill, we don't even use it in the manufacturing. It is used elsewhere. Maybe the administrative people, they are the ones who use the telephone. But still, that cost also we have to incorporate into the product, no? If not, if we only incorporate direct material, direct labor, and then add a profit to this and give a selling price, we will have big losses. We have to incorporate this as well, right? So what we do with these overhead costs is, first thing, we add it all up together. Okay, we add everything together. Let me add it. Give me a second. Okay, we add everything together. 14,500. This is the overhead cost. Okay, that is the overhead cost. Now what I do is, I divide this by what we call a base. Okay, by a base. So base means this can be anything, like for example, labor hours. It's a very common one. It can be machine hours, another common one. Okay. And what I do is, I divide this figure by a base and I calculate something called the overhead absorption rate, or the OAR. Okay. So let's say I'm just using labor hours. Let's say labor hours total was 10,000. That I will know, no? How many labor hours I worked, I will know. So if I'm going to calculate OAR, it's going to be 14,500 divided by 10,000. OAR is 1.45 per direct labor hour. Okay, so this is the OAR. What I will know is how many direct labor hours I used in my product. How many direct labor hours? Let's say, for example, I know one table, we took 1 hour to make it. So what I can do is I can incorporate the overheads by simply putting 1.45 multiplied by the number of direct labor hours that I used in that particular product. So in this case, it was 1 hour. So the overhead cost I'm talking about will be $1.45. If I had another product that used about say 50 direct labor hours, then the overhead portion of the cost, I will put it like this, 1.45 into 50 hours. Understood? So depending on the number of direct labor hours or the direct machine hours that I spent for a particular product, I can incorporate my overhead expenses as well. Okay. And this, when I do this type of costing rather is called absorption costing. Absorption costing. Okay. Now here, it's a very simple question that they're asking you, right? So let's read through this. They're saying, overheads in a factory are apportioned to 4 production cost centers, A, B, C, and D. Meaning, the total overheads that I have, I am splitting it into 4 different production cost centers, A, B, C, and D. Direct labor hours are used to absorb overheads in A and B, and machine hours are used in C and D. The following information is available. Okay. So we have the expenditure, we have the direct labor hours as well as the machine hours. They're asking you which cost center has the highest hourly overhead absorption rate. So you have to calculate OARs for everything. You have A, B, C, and D. Then you have the overhead expenditure, which is 18,757, 29,025, 46,340. Okay. And 42,293. Right. So now for A and B, they are saying to use labor hours to absorb overheads. Right. So let's put the labor hours. For A, it is 30,080 and B, it is 6,750. And for C and D, they're asking to use the machine hours. Okay, so that will be 3380 as well as 2640. Okay, now we need to calculate OAR. So it's very simple. You take the overhead and divide it by the labor hours. So you can, 2 decimal places are enough. Okay. So over here also do the same. 29,025 divided by 6,750. And over here it will be 46,340 divided by 3,380. And here it's going to be this divided by this. They're asking you which one has the highest OAR. Obviously, 16.02 is the largest number from these 4. So the answer will be production cost center D. Okay, simple. Right, so that's D there. Okay. 19.8, it's a good idea to always read the requirement first. It's saying, using absorption costing, what was the profit for the period? Okay, so I have explained to you what absorption costing is. Why do we even give it the name absorption costing? Because of the way we deal with the overhead cost. Okay, so using this approach, how will we calculate profit for the period? That's the question. Have a go. What do you think is the answer? Drop your answers in the chat. I'll keep this one in case you want to copy it. They're just asking for profit, right? So you don't have to worry about which cost to take or not. Every cost you have to take. Okay, that's the first thing. Next thing is, if it is a profit, it will be easier for you if you use an income statement like structure, because usually income statement also gives profit. Okay, so I have a feeling some of you might be stuck. So let me just start off, right? So usually, if you have an income statement, we start with the revenue. Okay, so let's read through and see what they're saying here. It's saying MG company sold 56,000 units of its single product in a period for a total revenue of 700,000. So they've given me the revenue figure. Finished inventory increased by 4,000 units in the period. So basically, closing inventory is 4,000 units. Okay. Costs in the period were, we have a variable production cost of 3.6 and a fixed production cost of 258,000 absorbed on the actual number of units that you produced. Fixed non-production cost is 144,000. They're asking you what was the profit for the period. Okay. Now, first thing is, if you want to know profit for the period, you need sales revenue, which you have. From that, you should deduct the cost per unit into the number of units that you produce, right? Obviously. Now, the thing here is, the cost per unit is not given, I mean, the total cost per unit is not given directly. Okay. We have the variable cost per unit, 3.6. And they have given me the total fixed production. So basically the fixed cost or the fixed production cost per unit plus the variable production cost per unit only will give me the total cost per unit, right? So let me first get that figure. So I know that the variable cost per unit is given to me as 3.6. No problem there. Fixed cost per unit is the problem. Okay. So I know that the fixed production is 258,000. And if I absorb it on the actual number of units produced, basically I have to divide it by the number of units that I produced. So in the question, they're telling me I sold 56,000 units. But in addition to that, there was fixed inventory or finished inventory of 4,000 units. So that means ultimately I have produced 56,000 plus 4,000. I have produced 60,000 units. In that, I sold 56,000. 4,000 I have as closing inventory. So if I want the fixed cost per unit, I have to divide it by 60,000. Okay, so that will be 4.3. I'll just write the calculation here. 258,000 divided by 60,000. Okay, so now I can get the total cost per unit. 3.6 plus 4.3. 7.9. That is the total cost per unit. Okay. Now I need to find out what is my profit. Okay. So let me start with the revenue. I know that the revenue was 700,000. Okay, let me put it here. Then usually we have to deduct all our costs, right? So we'll start with the production cost. Okay, so there was a variable element. That is how much? We had a variable cost per unit is 3.6. multiplied by the number of units that we produced, which is 60,000 units. So 3.6 into 60,000. Take it here itself. Okay, 3.6 into 60,000, we're talking about 216,000. That's the variable element. Then we have the fixed element, which was 258,000. No problem there. Now, usually in an income statement, when you have the cost of sales, you should not forget to deduct your closing inventory. Okay, so don't forget that. Okay, so if you look at closing inventory, there were 4,000 units and we have to value that at the total cost per unit of 7.9. Closing inventory, you can't value only at the variable cost per unit or fixed cost. You have to value it at the total cost, that is 7.9. This will be 4,000 into 7.9, which is 31,600. And usually this 31,600, you will be familiar, it's deducted. So minus 31,600. Okay. So 216,000 plus 258,000 minus 31,600, you'll get a total of 442,200. Now that total obviously has to be deducted from the revenue. So let me just put it as negative itself. 442,200. Okay. So 700,000 minus 442,200 is 257,600. Okay, 257,600. Now, this is definitely not the profit, right? Be careful because there was a fixed non-production cost as well, which you have to deduct. How much was that? 144,000. So minus 144,000. Can get your profit, which is 113,600. So this is the profit. So answer is 113,600. Answer is C. It's not always very straightforward. You have to think a bit to figure out the profit. Okay. Right. So what I'll do is, since we started at 6, take this down and then take a break. It's 8:05 now. Come back in 15 minutes. So 8:20. and then we'll do another 20 minutes. Sorry, we'll finish off at 9. So we will have 40 minutes to do a few more questions. Okay, but take this down first and then leave. The next area, actually, yeah, that's important. So it's a good time to take a break because the next one, I have to explain it a little. Okay. Yeah, sure, Husna. I'll go through this quickly since you're online before the others join in, okay? So in this particular question, they're asking you to calculate a profit. Okay, so if you want profit, it's basically your sales minus your cost. Wait a second, I'll switch on the video. Yeah. Okay, so it's your sales minus your cost. The only thing is they're not giving you the total cost per unit. You can't take sales minus only variable cost now. If you're taking, you have to take sales minus the total cost. So that's why first thing is we have calculated the total cost. So what have we done? Taken the variable cost per unit, added the fixed cost per unit. So how did we get the fixed cost per unit? It's 258,000 divided by the number of units. They're telling you it's absorbed on the actual number of units produced. Okay, so 258,000 divided by 60,000, that will be 4.3. You get your total cost as 7.9. Okay, so your revenue, which is 700,000, this is basically a structure of an income statement. Usually you have revenue, then you will have cost of sales, right? In this case, we'll call it the production cost because we're taking the revenue minus production cost. So if you take production cost, we can split it into two, variable and fixed, okay? So variable was 3.6 per unit. So we multiplied by the number of units we produced, which is 60,000. 56,000 plus 4,000. So then you get 216,000 as the variable cost. Fixed cost is already given. And like in any income statement, the closing inventory, it has to be deducted. Okay, so you can't forget that bit. Let me just bring this down. Yeah, so we have the closing inventory. Now, anything with regard to inventory, if you are valuing it, you can't value it at only variable cost per unit or the fixed cost per unit. If you're valuing inventory, you have to value it at the total cost per unit, which is 7.9. So we had a closing inventory of 4,000. We multiplied by 7.9. You get 31,600. In any income statement, closing inventory is deducted from the production cost. So 216 plus 258 minus 31,600 will give you 442,200. So if you want your profit, you have to take the revenue and deduct this cost. This is the production cost alone. Okay, so we can't stop at 257,600 because we have a non-production cost of 144,000, which has to be deducted as well. Okay, so from 257,600, you deduct the 144, you get your profit, which is 113,600. Is that clear now? Okay. Okay, so hope you got that. There were a few more, I think, so I'll just give a minute or two and then I will do the next area. Okay, let's start. Okay, now this 19.9, I can't stress this enough. This is a very common area that they test. Okay, they can ask different types of questions. Okay, but the area that I'm talking about is the same. Okay, so listen carefully to what I'm trying to say here. Now, when it comes to costing a product, traditionally, there were two methods that we could use. We could either use absorption costing or we can use marginal costing. Now, understand that this is management accounting, right? This is not financial accounting. Management accounting means there is no hard and fast rule saying you have to use absorption or you have to use marginal. It's up to you, up to the company to decide whether they want to do using absorption costing and using marginal costing. It's up to them. They will choose depending on their requirements. Whatever is easy for them, they will use. But the thing is, if you want to compare, most of the time the problem happens, if you want to compare maybe your financials with another company. Now, the first problem that arises is, say you're using absorption costing, competitor is using marginal costing. You're using absorption, your competitor is using marginal. Now, obviously, you can't make a direct comparison because we're using two different techniques, right? So, in this situation, we should be able to convert our profit, whatever we calculated, using obviously absorption costing. Whatever we calculated using absorption costing, we should be able to convert it to an equivalent marginal costing profit. What does that mean? We had a profit using absorption costing, let's say $56,000. The question is, suppose we used marginal costing principles, we didn't use absorption costing, then what will the profit be, or what would the profit have been? Suppose we used marginal costing instead of absorption costing. Or it can even go the other way around. Maybe we are using marginal costing. What will our profit be? Suppose we used absorption costing. Okay. So the point I'm trying to make here is you should be very good at doing this. If you have a profit for absorption, say, okay, so let's say we have the absorption profit. You should be very good at converting this to marginal profit. And the other way around as well. You should be good at this. Okay. Now, how do we do this? That's the question. Okay. Now, there is a formula that you have to learn. And that is this, right? The difference between absorption costing profit and marginal costing profit is the change in inventory multiplied by the OAR, or the overhead absorption rate. Okay, the difference, meaning difference means it's like this. Let's say absorption costing was 56,000, marginal costing profit is 60,000, difference is 4,000. So if I were to calculate this 4,000, how will I do it? Using this formula, change in inventory into OAR. Okay, so in a future question, we'll see how to do the numerical part of this area. For now, let's just learn the theory. Okay, so the difference is calculated using this change in inventory into OAR. It's very important for you to remember this formula. First thing. Next thing is, now you can calculate the difference as 4,000, right? But you have to identify whether, now for example, marginal costing, let's say we didn't know it was 60,000. We know that the difference between absorption and marginal is 4,000. Now the question is it 4,000 more or is it 4,000 less? Because either way, difference is 4,000. So we have two options, right? Marginal can either be 56,000 plus 4,000, which is 60,000. Or it can be 56,000 minus 4,000, which is 52,000. That is also possible. So how do we decide whether it is 60 or whether it is 52? Okay. So how we do that is, if inventory increases in that period, okay, if inventory increases, then as a rule, remember this, absorption gives the higher profit. And if inventory decreases in that period, then marginal gives the higher profit. If inventory is unchanged, meaning there is no change in the inventory levels, then both give the same profit. This is very important. You have to learn it. Okay, it's very important for you to learn these rules. Marginal. Okay. So using this, they can ask a question like 19.9, or they can even ask you a question with real numbers as well. So we will see that at a later point, maybe today, maybe next week. But either way, you need this theory to be able to figure this out. Okay. So it says here, a company with a single product sells more units than it manufactures in a period. Increases is yes, correct. Okay. So a company with a single product, they sell more units than it manufactures. Okay. So if you sell more than manufacturing, you're selling more, you're manufacturing less, right? That means overall your inventory, it will actually decrease. Inventory decreases. Okay, because we are only producing a particular amount, but we are selling more than the production. So ultimately, the amount of inventory that you have, it will decrease. Which of the following correctly describes the use of marginal costing in comparison with absorption costing in the above scenario? So they're saying compare the marginal costing with absorption costing. So ideally, if inventory decreases, marginal will give the higher profit. We know that. Okay, so let's see if that answer is there. Both profit and inventory values will be higher. That's wrong. Inventory is actually reducing. Okay, it's not increasing. Both profit and inventory will be lower. That is also wrong, because if inventory decreases, marginal will give the higher profit. Profit will be higher. Inventory will be lower. So profit is higher, great. Inventory is lower. So yes, this is the answer, C. Okay. So if you didn't know this, you will have a problem. Okay. So here, let me just change the words a little. Manufacturing might get confused. So sell more than production. Or production is less than sales. Right. Okay. So in case you don't have these formulas, please take it down. It will definitely help you. If you have it, then you can try 19.10. Those of you who don't have this is very important, guys. So please take these formulas down. And then you can try 19.10 and give me your answers. Correct. D. Okay. Right. So this is actually another area of process costing. Okay. It used to not be of much importance. We used to not give it too much importance because, like I said, there were other areas to test. But now that those areas have been removed, I tend to see this byproduct, joint product area come up quite a bit because they don't have anything else other than this and normal losses, abnormal losses to test from process costing. Okay, so let me talk about this joint products and byproducts. Okay, that's the area we're going to talk about. So joint products and byproducts. Okay. Now, if you take process costing, guys, there is something about it that's special, right? That's why we call it process costing and we give so much of importance to it. What is special about process costing? You go through many processes to make your product. So for example, if you're making tables, let's say, you go through many processes like a cutting, okay, maybe a sanding, then a painting, then after that the assembly, or maybe the assembly and then the painting, then the polishing. There are many processes until you end up with your end product. Usually that is the case with process costing. And most of the time this becomes a problem actually if your product is taking a long time to manufacture. So for example, if you're making cars or something, you will have to take quite a while, right? You have to make the body, you have to make the engine, you have to fix the tires, you have to make the seats, put in all the glasses, lights. There are a lot of processes that you have to complete. Only then you will end up with your finished product. So usual process costing, the situation is this. Usually, the situation is you have many processes, but one product. Now, these joint products and byproducts, it's the exact opposite. Okay, you have one process, but many products. That's the difference. Okay, so the problem that we have with this method is, since there is only one process and many products, in this process, you might have incurred something called a joint cost. Okay, let's say a joint cost of 500,000. I'll explain this with an example. Let's say there was joint cost of 500,000. The problem is we don't know what portion of this 500,000 should be given to each of your individual products. Okay, so let me explain this properly with an example. And let's say again, today we are making perfume. No, so let's make perfume again. Okay, now I don't know how to make perfume, guys, honestly. I'm just guessing that. Let's make it this way. Okay, so let's have a huge container. Okay, and let's say we're making rose perfume. Okay, so what do? I go and I collect some rose petals. Okay, and I put it into some water. Okay, I put it in some water. These are petals, rose petals. Let's say I do that. I keep it like that for about 8 hours. Then what do? Let's say I have 2 taps. Okay, so let me just fill a lot of water. Okay, not this much. Let me fill this much water. Okay, I have a tap here and a tap at the top. Again, I'm telling you, I don't know if this is how they make perfume. I'm just assuming. Okay. And at the bottom, obviously, since this is closest to the petals, I will get concentrated perfume here. Concentrated means has a lot of smell. Whereas at the top, I will get more dilute perfume. I'll get more dilute perfume. Now, if you're into perfume, you will know that concentrated perfume, we have a specific name that we give for that. We call that, I don't know if this is the proper pronunciation, UD perfume, something like this. It's French. Okay. Usually, this is more expensive. If you put about 2 sprays even, it will stay for the whole day. Okay, UD perfume. The dilute perfume, we give it another name. We call it UD toilet. I don't know if that's how you spell it. Again, it's French. So this is where, you know, it will be very mild. It will be more like water. And when you spray it once or twice, even if you use about 10 sprays, in about 1 or 2 hours, it will go, the smell. Okay. So basically, in this process, I end up with 2 products. So you can see one process, I just put the petals in the water and then I get 2 products. Now, these 2 products, we call it, we give it a name. We call it joint products because they are made in the same process. Okay. Now, the problem is this. Now, let's say to collect these petals, to fill the water in that particular container and to make the container, all of that, let's say we incurred a cost of 500,000. Right. Now, the question is, of this 500,000, how much can I give to UD toilet and how much can I give it to the perfume? Because both are joint, we have to figure out a way to properly divide it amongst the two. So that is what we tend to do numerically in this chapter. Okay, so this question, they're not asking you basically about the numbers, they're asking you just a little bit of theory. Okay, so one last thing that I didn't mention is, let's say these petals are there. Now, after we take the water, we just have petals. Okay, now these petals, obviously we can't use it as flowers. Let's say we sell it to a farmer as compost. He can go and put it for his crops or something. Okay, so we give him maybe like about 10 kilos of, we give him, let's say, about 10 kilos worth of this petals for a small price. Let's say we give it for just $1 per 10 kilos. And let's just say this toilet, UD toilet is sold at, let's say, $100 a bottle, I'm just saying. And this is sold at, let's say, $200 a bottle. Okay. Now, this compost or the petals that we're selling to the farmer, you can see in terms of the price, it's significantly lower than the joint products, right? It's not your main product. It's just something that's happening on the side. You're just giving it for almost free, but it's not free. You get something out of it. So this kind of product, we don't include it as a joint product, although it is also produced in the same process, because it is not one of your main products. We call it a byproduct. So what's the characteristic? In terms of monetary value, it is much lower and it is not one of your main products. That's the byproduct. So the way we deal with the byproduct and the way we deal with the joint product obviously is different. Okay, so that's the theory behind this joint products and byproducts. So let's see 19.1 or 10, sorry. What is a byproduct? A product produced at the same time as other products, which has no value. That's wrong. Very wrong, right? It is lower in value, but doesn't mean it has no value. It has some value. If it doesn't have value, then we don't call it a byproduct. Then it's just waste. Okay? A product produced at the same time as the other products, which requires further processing to put it into a saleable state. That means they're saying after you make that particular product, now let's say even the perfume, once you collect the water, you can't just sell it in a small water bottle. No, you have to have a proper perfume bottle. You have to put it into that, and only you can sell. So that putting it into a bottle is called further processing. Now they are saying a product produced at the same time which requires further processing is called a byproduct. That is not the definition of a byproduct. Maybe a byproduct you will have to do further processing, but that doesn't mean that is the definition, right? So that is also wrong. A product produced at the same time as other products which has a relatively low volume compared with other products, right? Now we don't really talk about the volume. Okay, maybe it is low, maybe it is high, but we are not comparing it with in terms of volume, right? We will compare only the price. So D, C is also wrong. D, a product produced at the same time as other products, which has a relatively low value compared with the other products. So yes, that is correct, D. Because you can see, compared to the other two joint products, this product is relatively cheaper, actually very cheap, right? So the answer there will be D. Right, so that wraps up that 19.11. This is actually again a very, very common area. I'll tell you what method you have to use. Okay, I'll tell you what method you have to use. You have to use the high-low method. Okay, I will tell you what the high-low method is also. Okay, so it's like this. There are certain costs that are semi-variable. I spoke about semi-variable costs earlier today. Now, if a cost is semi-variable, if you want to split the total cost into the fixed element and the variable cost element, you have to use the high-low method. Okay. Now, in this question, they are asking you the total cost in a budget that is flexed at 77% level of activity. In addition to the high-low method, you can use a normal method as well. So, I don't want to give it away. I'll give you some time. See if you can figure it out. Okay. Right. I'll just give you one more tip. The first step is you have to figure out whether a cost is a fixed cost, a variable cost, or a semi-variable. That's the first step. And then if you decide that it is semi-variable only, you have to go with the high-low method. Okay, sorry guys, there was a drop in my connection. I'll share the screen again. Sorry about that. Something's up with dialogue today. Right. Okay, so I think you had time to at least figure out what you have to do. So I'll start it right now. Okay. Right. So the question is asking you, CA company. Yeah, by the way, in case in the future also you suddenly find myself out of the call, just give me a minute or two, I'll be back. Okay. So we will always finish and start on time. CA company manufactures a single product and has drawn up the following flexed budget for the year. Okay, so we have at 60% capacity, 70% as well as 80% capacity. So we have the direct materials, labor, production overhead, other overheads, and the total cost. What would be the total cost in a budget that is flexed at 77% level of activity? That's the question. So they're saying they have flexed at 60, 70, 80. They're asking you, suppose I have to flex at 77%, what will be the total cost? Now, first thing is you have to figure out which of these costs is variable, which of them is fixed, and which of them is semi-variable. Okay, so the first and easiest thing to figure out is if something is a fixed cost, because that means at every level of activity, it will be the same. So if you look at direct materials at 60%, 120, 70%, 140, 80%, 160, definitely not fixed. Direct labor is also not fixed. It's not the same. Production overheads is also not fixed. Other overheads, you can see at 60% it's 40, 70% it's 40, 80% also it's 40. Okay, so this other overheads is definitely a fixed cost. So that will help us later. Now let's figure out what's happening to direct materials. Okay. Now I told you if you want to find out if something is variable in nature, you have to check the variable cost per unit for every activity level. So we have 60%. Okay, then we had 70%. Then we have 80%. Okay, so let's check what the direct material is for per 1% activity. Here it's not unit, so we can find it for 1%. So if you look at the direct materials, I'll just copy it down first, 120, 140, and 160,000. So if you look at the direct material cost for 1%, we're talking about 120 divided by 60, which is, okay, I put this percentage sign also. I'll just ignore that. So, because if you put this a percentage, it will be a big figure, right? So 60, 70, and 80. Okay, that's some sort of formula that's happening there. 60, 70, 80. Okay, so for 1%, I'm talking about 120,000 divided by 60. So that will be 2,000. And you can do that for all. For 70, it will be, okay, instead of doing that, I'll do it one by one. 140,000 divided by 70, which is again 2,000. And here 160,000 divided by 80, which is again 2,000. So this shows that direct material is a variable cost. Because if you take the total and you divide it with the activity, the per percentage, in this case cost, is 2,000 for all three levels of activity. So definitely direct material is variable. Now let's do the same for direct labor. Okay, so we have 90,000 and 105,000 and 120,000. Okay, so let's get direct labor for 1% of activity. So that will be 90,000 divided by 60, which is 1,500. 105,000 divided by 70, which is 1,500 again. And 120,000 divided by 80, which is again 1,500. So both direct material and direct labor, they are variable costs because they are not changing as the activity level changes. Okay. So we have done for direct material and direct labor. Let me just highlight this. Let's try for production overheads also. If that is also variable, then no problem. So production overheads. So the figures are, we have how much? 54,000, 58,000, and 62,000. Okay. So let's get it, the production overheads for 1%. So this will be 54,000 divided by 60, which is 900, divided by 60, sorry, not 60, 70, right? That is 828 odd, and 62,000 divided by 80, which is 775. Now you can see if I take the production overhead and I divide it by the activity, okay, I'll call this activity, I have a big problem. It's not a big problem. The problem is that when I divide it by this activity level, the production overhead per 1%, it's not the same. Okay, so this means this is not variable. It's not fixed also. So it is a semi-variable cost. If it was fixed, that means the totals will be the same like other overheads. Yeah, that's also another case. So this is semi-variable. Okay, so the moment you have a semi-variable cost, if you want to flex it, you have to first identify what is the fixed cost component and what's the variable cost component. Okay, right. So, right. So if you have a semi-variable cost, how do we do this separation? We use something called the high-low method. Okay, and the high-low method has some steps that you have to be familiar with. And there is also a structure. Okay, so what is the structure? You will have the high on one side and the low on the other side. And you will have activity and its associated cost. This is the structure that you have to have. So if you look here, the highest activity level that we have is 80 and the lowest that we have is 60. So that will be the activity levels, 80 and 60. And at 80, the cost is 382,000, is it? Ah, no, sorry. Yeah, the entire cost is not semi-variable, right? We only are interested in the production overhead cost. So at 80%, the production overhead is 62,000. And at 60%, it is 54,000. That's the first step of the high-low method. Step 2 is you need to take the difference. Okay. So that is 80 minus 60, which is 20. And here 62,000 minus 54,000, which is 8,000. Okay. So that's the difference. Then the next step is you have to get the variable cost per unit, right? So for that, you have to take the difference in the cost, which is 8,000, and divide it by the difference in the activity level, which is 20. So the variable cost per unit is $400. Okay, so that's the next step. Finally, we have to get the fixed cost element. So for that, we use this equation, total cost equals fixed cost plus, usually open a bracket, variable cost per unit into the activity level. Okay. Now at this point, you have to substitute either the information from the high or the low. Okay. So usually as a habit, I usually substitute high. So substitute high. Total cost was 62,000. Fixed cost is what I want to find. Plus the variable cost, I calculated it as 400 multiplied by, at the high, the activity was 80. Okay. So you can rearrange this equation, take 400 into 80, whatever that answer is, deduct it from 62,000. So your fixed cost, you will get it as 30,000. Okay. So now we have the fixed cost element as well as the variable cost element. Now using this, it will be easy for us to flex like how they ask in the question. It's a fixed cost is also there. Okay. Now they're asking you what would be the total cost in a budget that is flexed at 77 level of activity, right? So first let's start with the direct materials. Now we know for 1%, direct materials was 2,000. Okay, for 1%, it's 2,000. So if you want for 77, that's going to basically be 77 into 2,000. Okay, so that will be 154,000. Direct labor for 1%, it was 1,500. So if you want for 77%, 1,500 into, let me do it the other way around, 77 into 1,500. So let me see, 77 into 1,500, which is 115,500. Then for the production overhead, you have to include the variable element and the fixed element separately because it's a semi-variable cost. So with regard to variable, it was 400 per, actually in this case, it's not per unit, right? It's per percentage. It's fine. You can just call it 400 into the number that we have, that is 77%. So 77 into 400, that is 30,800. And the fixed cost element was just 30,000. So you just have to put it as it is. And then this other overhead, it is a fixed cost. So it will just be 40,000 regardless of whether you do 77% or 80% activity. It's 40,000. Okay. Now all you have to do is take a total. So let me take the total. Okay. So that will be 370,300. So the answer there will be B. Okay. Any questions over here? How to do the high-low method? Let me just make this bigger. Okay. So I'll just go through this once more. First step is you have to figure out whether it is variable cost, whether it's a variable cost or whether it is a fixed cost. So how did I do that? I took the total and I divided it by the activity. And I saw, okay, for direct material, I can see regardless of the activity level, the direct material cost for 1%, it remains the same. The same thing happened for labor as well. Whereas when I did for production overheads, something else happened where the production overhead for 1%, it kept on changing. So that was the sign for me to identify that this is not a variable cost. It is a semi-variable cost. So the moment I know that it is semi-variable, I have to do the high-low method. I'll take it to the other side. Okay, I have to do the high-low method the moment I know that it is semi-variable. Okay, so I did the high-low method. There were a few steps that you have to follow. You can get the breakdown of the variable cost component and the fixed cost component. Okay, now once you're done with that, we don't have to think too much. After that, you just have to do like a small cost card. Okay, so this is how you identify the total cost. Any questions, guys? Or is it clear? Don't worry, we will do a lot more of the high-low method throughout this TRG. So even if you feel that you're a little not sure about the high-low, should be okay. All clear. Good. Okay, so take this down. That will be it for today. We will start from the 12th question next week onwards. Okay, so if you can just take a quick picture of this so we can end the meeting. If you want, you can take it down leisurely. Okay, a picture, screenshot, whatever works for you. Okay, let me know once you're done with taking the picture so I can end. Okay. Right. So yeah, this will be how the format goes. Okay, this is what we will be doing for the next 4 days. Which obviously it will be 1 class per week. If you all have any specific areas that you want me to look into, please let me know. I will try to incorporate it into the TRG. Okay. Right. So that's it for the day, guys. Have a great week ahead. I will see you next Thursday. All right. All right. Thank you. No problem.